Greg Peters joining us right now, co-CIO at PGIM Fixed Income. And Greg, I'm going to piggyback off what Alex was just talking about here. Can we take investors, can they take that playbook from that 2016 to 2020 era and apply it to whatever that 2025 to 2029 era is going to look like?
I don't think you can completely, as the preconditions are very different today, right? If you're looking at just where we are economically, we're in a very strong place. Inflation, is definitely much higher. Markets on a very different plane. So I think it's somewhat inaccurate to use what happened in 2016 to today. But alas, that's what you're seeing. So what you're seeing currently is that investors are kind of dismissing any of the negativity around tariffs, any of the negativity around immigration, for example, and really kind of uplifting and bolstering some of the more favorable potential policies like tax cuts and deregulation.
There's been a narrative since the election of this idea that the administration coming in is going to be relatively pro-business, at least relative to what we saw out of the Biden administration. And that could sort of create favorable conditions, whether it's for M&A activity or new business creation, et cetera. I'm wondering, Greg, if you see conflict between some of those pro-business policies that I think the market is counting on and things like tariffs and other proposals that have the potential to detract from the economy and the markets.
No, absolutely. And I go back to where I started, which is investors are only amplifying the good and they're, not really focused on the potential negatives. So, I do think the volatility, the uncertainty, the more idiosyncratic nature of this administration, coming in doesn't always engender confidence, right? If you go back to, the first term, there was a lot of bolts from the blue that hit, whether at the individual corporate level or just from an overall policy level. So that makes it harder to, do M&A, makes it harder, I think, to push the markets to a much higher plane. What I think it does say ultimately is that volatility will remain quite elevated here.
Which then begs the question what it winds up meaning for the Fed. I mean, already in the minutes today, it seemed like they could cut more or they could pause depending on what the data called for. And we're already looking at little over 20 basis points worth of cuts just in the next couple of meetings. Like, we've re-rated so much, and you have to wonder if the headline and volatility risk changes that dynamic even more.
Yeah, so I think the markets were way offside as far as where the Fed was predicted to go. I think we're in a much more stable, thoughtful place today. But the way we think about it at PGIM Fixed Income is that we want to get to neutral. And so I know neutral is very much of a debated concept, but think of it as a range from 4% to 2.5%. And if you think about where central bank policy rates have been set, they were set in a much, much higher inflationary type of regime. So we're not in that regime anymore. So I think we get to 4%. And then we revisit, and that's lower than where we are today. And I think that's the real message here.
When we talk about volatility, Greg, and I know you're a fixed income guy, but where do we see the most volatility, in what asset class, and then how do you manage that?
Well, where the volatility has been in fixed income. So I expect that to continue. I mean, the moves that we've seen in the front end, the 2-year, for example, even the 10-year has been nothing short of extraordinary. What's really notable here is typically what you see is when the Fed, in this case, starts cutting rates, volatility comes down. We haven't seen it this time. So I don't know if it's a canary in the coal mine or not, but it is quite notable that you haven't seen volatility really trend lower in a meaningful way in spite of the Fed embarking on a rate cutting cycle.
How tight are the correlations right now, though, Greg, when we look at the moves, or to a certain extent the lack of moves in the Treasury market, and then you overlay that with what we've seen in equities and even what we've seen in the FX and the commodity space here? Are you still seeing strong correlations, or traditional correlations, I should say?
No, you've seen it switch around. That's one of the positive aspects here around active investing. You've seen those correlations break down. You've seen them move. You've seen it particularly from a global bond market perspective. If you think about kind of what's happened in the Bund space versus treasuries, so we're most excited around those correlations actually lightening and switching. Kind of the worst type of investment environment is when there's a correlation of one across. And thankfully, we're not in that type of environment going forward. So I expect that to continue. I expect those correlations to break and lighten and switch. And I think that's the real investment opportunity for 2025.
As people look to 2025, and particularly the opportunities, they are focused on the risk. We've touched on a couple of them already with regards to tariffs, immigration, et cetera. I do want to get your thoughts specifically on the fiscal situation, based on, I guess, some of the speculation of what we know about the potential incoming Treasury Secretary, as well as some of the other policies that the Trump economic team, at least the ones that he has assembled for nomination, have been espousing. Do you anticipate that that could have a major impact on rates?
I do. One of the real concerns, that I have and we have at the firm is the fiscal situation. You look at, the tax cuts being rolled forward and some other agenda items. You're not seeing any change on the fiscal side. There's talks around, cutting some fiscal expenses. That's a really, really small portion. So I think fiscal profligacy is here to stay, and ultimately the bond market will react. I think the most telling statistic is if you look at kind of interest costs 10 years forward, it almost equates to 25% of the income coming in. So we're getting dangerously close to this, what we call debt trap, debt spiral, and the markets will focus on it. The worry is that you never know when the markets will really, truly in earnest start to focus on it. So that is the principal concern that I have going forward.
Well, Greg, it seems like what you're talking about is a Liz Truss moment where something is unveiled and the market decides this is not sustainable, and then bond yields spike higher, causes chaos. But couldn't we have said this 10 years ago?
Well, that's the thing. You don't know till you know. But I do think what's happened in the UK, is a warning shot, so to speak. You had a whiff of it just a couple weeks ago, but in the UK as well. You've seen it in France. So the signs are there. So, the scary part is that you really don't know until after it occurs. There is a breaking point. There's no magical number. But at some point, the markets have to believe that the fiscal side is under control or there's a plan. And we haven't really seen a plan. And if you look at what happened in the UK as an example, it's been the lack of plan that's really kind of, hurt that the most.
So does that mean you had the conviction then to short the back end based on that, or what had his strategy?
Well, what I think it means is all else equal, there'll be pressure on yields, right? You look at the amount of Treasury supply coming, you look at the shifting buyer base who's absorbing that supply, you look at the policies on the table, all else equal, that creates a steeper curve, that creates additional risk premium. So I think the pressure will be yields higher, not lower, just based on the fiscal situation alone.
Well, when you say that, though, Greg, I assume you're referring to benchmark yields. What's the disparity that we can see versus the longer end of the curve and the absolute shortest end around the 2-year and less?
Well, so the curve's been extremely flat and inverted for quite some time. So, I could see that continue to move, higher. What that magical number is, I don't know, because that gets us back to the Fed side. So I think the Fed is equally worried around the growth hit to tariffs as it is inflation. So we'll see. But I think either way, the curve will be steeper going forward, not flatter. We're coming out of this extremely strange era of curve inversion, and we're moving back to some sort of normalcy.